This is our Forex blog for October 13th, 2011. And like most days, we really want to buy the strongest currencies versus the weak and sell the weakest versus the strong. The dollar and the yen were both weak for the last 2 days, extremely weak. So it's not surprising after a couple down days, you can have a counter trend move. So you always have to be careful after a currency's gone 2, 3, 4 days one direction. You can have a counter trend day that lasts pretty much the whole day, like for the most part the dollar and the yen did. Starting the day off, they're both weak, and you can see a little bit of strength here, less weakness, a lot of strength, less weakness. It's pretty safe to assume the strength will return, but then you get a little bit of weakness here, so at that point it's not sure whether the weakness will continue or the strength. Then you get a lot of strength here, followed by less weakness, more strength, less weakness, more strength. That's a pattern you want to really look for. Once you see a pattern of strength, less weakness, more strength than the previous weakness. If you don't have that much weakness, either in terms of number of bars or more importantly, very low intensity, usually the previous trend will continue. In this case, we have the intermediate time frame up, daily trends down still because of how much down it went the last few days. Weekly trends down, the monthly trends up. So obviously on days like this, even if you aren't scalpers, your probably best bet is to be a short-term, trader. Take the swings to the upside when they're available. If you see the momentum slowing down, look for counter trend trades. Back in the direction of, the dollar being weak. Same thing with the euro. Euro and Australian were extremely strong over the last few days, and started off today strong. You can see a little bit of weakness here, followed by almost no strength, and then a lot of weakness right here that lasted for 3 hours. So be very cautious on days like this. Some of the strongest currencies can become weak for a day, sometimes 2 or 3 days before their longer term trend continues. So looking at this, let's say you started to look for sells in the dollar and the yen early on. The euro was strong early, so from a little bit before midnight till 1, you can look for buys in the euro. And the euro last night pulled back to the hourly here and found support at the hourly. It also had a narrow range 7 pattern, broke out right here, not a bad trade, went right up to the resistance area. Couldn't even get to yesterday's high. Right? So there's your first sign that possibly today's move is not going to continue. And then it pulled back and broke underneath the hourly. And typically, when that happens, you want to look for sells. You would have got into a trade and probably lost. Then it broke back above the hourly and you'd buy again because the previous few days has been up. And you can see it went up about 25 pips. And then when it broke down again, it barely made a higher high, hit one of my Fibonacci areas, couldn't even hit yesterday's high. Because this currency's been up too much statistically, it was likely to reverse. So let's take a look at this one on a range chart. Here's the euro dollar, which we'll fast forward into today. This was stuck on yesterday. Using the range charts, quite a bit easier to trade. If you see a currency go from underneath to above the hourly and it breaks out, you can get in. Notice your trailing stop has you out here with a small profit. If you decided to buy this little sideways breakout right here, you had a loss. Once it broke underneath the hourly and came back and retested it, you went short right here again with a pretty much a break even or 2 or 3 pip loss. The fact that it went down, double bottom with less weakness and broke back above the hourly here, the trend was up. The daily, weekly, monthly trend's up, so you got to take this buy here. It's either going to go back up to the highs, install most probably, or if it breaks above there, it should explode up. If it doesn't, that's a pretty big sign of the trade not working. So you can see this breakout right here lost a little bit as well. I would wait for it to break above the high here to go long, or underneath the low here to go short. You can see the statistical strength is kind of subsiding a little bit. So if you bought this breakout right here, you can see it has less strength than it had before. You got to be careful up here at the highs. If it can't break these highs or goes above them and then back down, you got to get out of your trade. You're only up 10 or 12 pips right now. So I'd get out of half the trade right here, and then use the trailing stop for the other half. So you're out with 10 pips on half and maybe 15 pips, 20 pips on the other half. Now at this point, don't know if it's going to reverse. If it comes back down to the whole number and hourly moving average, it's likely and finds support there and doesn't go underneath it, you'd want to buy it there. So it came down to the hourly and it broke it. So, it did not find support there, so the trend's likely to be down. You can take a chance on these. Usually when they break the hourly, they'll go 10, 15 pips, then come back up and touch it. It's a safe place to sell. If you see a currency getting weak all of a sudden and the currency meter supports it, you can always go short with a very, very tight stop, a pip above that bar's high, and then use the trailing stop to get you out, or the first sign of a green bar, take your 12 or 13 pip profit on the first half and trail the second half. You can see our intelligent trailing stop has kept you in there, and it's still in there. So you're finally out somewhere around 46. So you made 35 pips on half. Maybe you got out of the first half with 10 or 12 pips just to be safe because it was a risky trade. And you can use the range bars, to take these kind of trades. And because the dollar was strong today and not weak, you're looking to buy a pullback or sell a pullback in this. Usually they'll pull back 38 to 50%. If it's super weak, it won't even hit the 38% level. But I would expect at least a 3 to 5 bar pullback with green bars up. One of the methods that we use, this isn't enough of a pullback for me, but if it had gone up another 1 or 2 bars up and then 1 red bar down, you sell it when it goes 1 pip below the low. So by waiting for a deeper pullback, you can avoid these low odds trades like this near the low. So now it's come back up to the fib level. If you wanted to sell it now, it's quite a bit less risky and higher probability. You're either going to have a small loss, or if the trend continues down, you're going to see it go way below or back down to this low down here. And notice how our trailing stop has kept you in it. And it came down to a weekly pivot level. I would exit half the trade there and let the trailing stop get out of the second half, which it did soon after. By waiting for a deeper pullback, you made 40 pips pretty much on this trade. And you can see extreme weakness on the way down, followed by a decent sized pullback with almost no strength. It's pretty much a no-brainer. And at 5 in the morning right here, you can see that the dollar was very strong, followed by a little bit of weakness here, and that strength is likely to resume as it did. You can see at 5 o'clock right here, the euro hasn't had any strength since 1 o'clock, and going up on 5 o'clock, the euro was one of the weakest ones. So it was a very high odds pullback trade right near the 38% Fibonacci area, and the currency meter also supported it. It had you watching that currency. Another one that was also very clear was the yen. The yen was actually stronger than the dollar at the time. So the euro yen also is going to be one where you can look for sells going on near 5 o'clock. Here's the euro yen. And looking at this one earlier today, you can see last night it broke underneath the hourly, came back up and couldn't break it. When currencies are underneath the hourly, you want to look to sell them. So here, you can see it came down and found this monthly or weekly pivot level right here. Couldn't break it, or trailing stop got hit. You had a very small profit. It comes back up to the hourly right here, and you can see quite a bit of strength. So you might have actually even decided to buy this breakout right here, which would have had you lose about 8 or 9 pips. And then the same exact thing happened here. It had a false breakout from below to above the hourly. So you can, if you want to take a trade, this is probably only 50% winning, but when it works, it gives you a high profit. This was a lower odds, or I should say a increased odds trade than the euro dollar, because this one really couldn't get above the hourly, whereas the euro was initially, back at midnight, it did break above the hourly. So the dollar was less strong than the yen. This is a major support area, so if it goes down and hits a support area like this, you might want to exit half your trade with 10 or 12 pips. and then use the trailing stop to get you out of the other half. It's intelligently designed to keep you into the trade as long as there's weakness. If the weakness resides or subsides a little bit, we tighten the stop. And if the market moves statistically too much, we tighten the stop as well. You can see what a wonderful job it does keeping you into this super tight stop. In my opinion, I've never seen a trailing stop work as well as this new one that we've just released. And it allows you to set the settings, and it uses all of our statistical tools with whatever time frames and whatever weights you want, and it lets you set the initial multiple and how much it tightens when certain situations happen. And it also can be used on our incredibly powerful range chart. So 2.5 times a 6 pips per bar would be a 15 pip stop maximum. You're never going to risk more than 15 pips. So you can use our position sizing tools to come up with an intelligent number of lots to trade, and you'll keep your losses small all the time. And you'll know that when the trend is real, the trailing stop's going to keep it as tight as it possibly can be without letting the noise of the market get you out, but also getting you out usually at the end of the move. When this gets stopped out, usually the market continues out for another 10 or 15 pips. Not always in this case, but it's down near the lower containment band, so you can see it's a pretty tight stop. Usually when these things get triggered, the market continues up another, what did this get stopped out at? Right here at 35, went up to 49. That's 14 more pips up. So, it's a very intelligent way of getting out of a trade. Now, if you missed that earlier trade down here, this is also a beautiful pullback trade. It fell a lot, it had incredible weakness, and then the counter trend move up had almost no strength. This is a no-brainer trade. Now, the only reason you would not take this trade is if it's underneath the white 2.0 band. But you're short somewhere around 72 and out here at 36 for a very, beautiful 30-plus pip trade. So I started today in the Forex blog to show more of our range charts and the intelligent build your own trend tools and the build your own trailing stop. This can be customized to any time frame trading. If you're a scalper, you can have a smaller number of pips per bar. You can have a tighter stop if you want. Or if you're a longer term trader, you can, instead of using 6 pips per bar, you can use 10 pips or 15. And you can have 3 times trailing stop versus 2.5, or you could even cut it to 1.5 if you want. It's up to you. And you can use some of our best statistical tools to measure how strong or weak the euro really is. From 4 to and after, you can see in our currency meter, the euro was very strong, and the yen was, for the most part, except for about a half an hour here, extremely strong. So when one's weak and the other one's strong, we're going to have a wider stop, and it keeps you into those huge moves like that. It's by far our best tool yet.